Okay, so and we are live. So basically, the fundamental thing that we'll be starting today is IFRS. And if you see, we have 34 standards to do. Okay, let me share my screen. Yes, so we have 34 standards, out of which I think we did one, before leaving for the season, which was prior period errors and yeah, it says basis of preparation, but it's actually prior period errors. And, whenever we need, yeah, change in accounting policies and change in accounting estimates. That itself was a very good standard. But instead of going on a half-assed way like this, what I thought is I will use this book. Okay. So if you see, it has a definite content. So it has introduction, like the nominal things which we discussed way back, and also there is international sources of authority which we already discussed, which includes the regulatory framework, sustainability and ethics, and also the conceptual. This was what we did pre-season. Okay, now the things are about elements of financial statements. Now what is meant by elements of financial statements? Let's say, given a financial statement, what are the things it would include? It could include, like revenue, other income, cost of goods sold, expenses, even for balance sheet for that matter, non-current assets, current assets. So these are the elements. So third chapter is all about elements, and one of the predominant most important element in any financial statement is revenue. Okay, the top line, as it is called, because revenue is a great indicator of how well you're doing, right? So how to record revenue, what are the things that should keep in mind while recording revenue, that is all about this chapter 3. And I'm sure that everybody would know these 5 conditions. There is a lot more than 5 conditions. Okay, the standard includes, the 5 conditions. Of course, this is the primary basis for recording revenue, but of course, more than that, there are many specific permutations and combinations involved. The sale may take the form, may take a lot of forms. Like it might be a principal versus agent contract. It might be a repurchase agreement. It might be a bill and hold agreement. There could be consignment agreements, which we see very frequently here in UAE. And of course, how to deal with all these specific aspects and what are the things we should keep in mind. We will go deep dive into the standard in total. Okay, so what I expect is, given the daily time of 1 hour, we would complete the standard in 3 days. So because this is a very big standard and there are a lot of things to understand. So the rules of the game are the same. If you have any doubts or questions, just stop me right there and then ask. The purpose of this is to understand it in full. Okay, if you have any problem with the words or any problem with the concept or the logic which is explained, please feel free to raise. Okay, meanwhile I will be trying to connect everything and explain everything, but then, if I miss, just let me know. Stop me there and let me know. Okay, so fundamental thing is revenue. What is revenue? Revenue is income arising in the ordinary course of entities activities, right? So whatever is your licensed activity, if you do that, what you earn is called revenue, right? So let's say that you are a trading company and you earn some interest income from fixed deposits. Is that revenue? Absolutely, because that your ordinary activity or the licensed activity is not receiving interest or dividend or the case may be. Okay, so this is all about, how do you recognize income from your core activities? Okay, from your ordinary activities. So this standard is a culmination. So there are two bodies involved: IASB, International Accounting Standards Board, who is forming and overseeing IFRS, as well as the US Financial Accounting Standards Board, FASB. Okay, phones only. So like, one fundamental thing which I saw here is that end of the day, IFRS is principle based. What's meant by principle based? Principally, it should be right. I mean, the option is given to you. Okay, but in principle, it should match the, or it should conform to the conditions mentioned in the standard. Right. So that just keep it in the back of your mind. So there are a lot of things which are principles based and which are giving you an option to choose which is right for you. But principally, you should explain. You have an obligation to explain why such a thing is better for you. Okay. We saw that in accounting policies. There are plenty of accounting policies here as well. Right. Now, when do you recognize revenue? You tell me. Is satisfied. Okay. So basically, like, a transfer of goods and services happens when you transfer control. And when you transfer control is when you can record revenue. Okay. When do you say performance obligation is satisfied? When the control for that particular good or service is transferred to the customer. So the word control is very important. Okay. Risk and rewards or anything which is an indicator of control should be substantially transferred to the customer. So let's read that. The transfer of goods and services based upon transfer of control. Control of an asset is described in the standard as the ability to direct the use of and obtain substantially all of the remaining benefits from the asset. So once the customer get a hold of this, what is this? Obtain substantially all of the remaining benefits and the ability to direct the use. Then you can say that the control is transferred. Okay, you can record revenue in plain layman language only when the control is transferred. Now let's understand the scope. Does it? Yeah. So let us understand the scope. Okay. But does it include all kinds of ordinary, income from ordinary business? Yes and no. So let's say that if your ordinary business is leasing, okay, you cannot use this standard, but you have to go by the scope of IFRS 16, even if it is your ordinary activity. If your ordinary activity is insurance, like you are an insurance company who's giving you contracts, you have to go by IFRS 4. You can't say that this is my ordinary business and I would be using IFRS 15. Okay, because specific over general, there is a specific standard for you. Then why come into the general standard? Same case with, like, financial instruments and other contractual rights. Like, you have to use IFRS 9, 10, 11, IAS 27 or IAS 28 as the case may be. And of course, non-monetary exchanges between entities in the same line of business is not coming under the standard. Now, what does it mean, non-monetary exchanges between entities in the same line of business? What is meant by non-monetary exchanges between entities in the same line of business? So let's understand that with the help of an example. Okay. Yes. So let's say that A is a company in Dubai, or let's say it is in UAE. Okay. And B is a company in Oman, right? Both are into the same, both are into the same line of business. So let's say that they are both doing oil trading. Okay. Now what happens is B has a customer C who's based in UAE. Okay. C is customer of B. And there is a customer is D who's a customer of A who's based in Oman. Very plausible, right? This is customer of A. Now what happens is, like, let's say D is contacting A. I want 1,000 gallons of oil and I want it in the next half an hour. Is it humanly possible to transfer these from the warehouse of A, which is in UAE, to D's warehouse in Oman within half an hour? No, absolutely not. So what A does is A ties up with B, tells B, who's in the same line of business, boss, I have a customer in your country. Can you just transfer some goods to him? Okay. So B says yes, of course, and he transfers that 1,000 gallons of oil to D. Okay. Now, same situation happens with B. C, who's in UAE, tells B that I want 1,000 gallons immediately. So what is happening? B is contacting A, correct? And A is transferring to C. So whatever A had to give B, now A is using this. Okay. A had to give the 1,000 gallons, right? Because he supplied to to A's customer. Now what B is saying, I don't want your money. What you do is you supply to my customer who's in UAE. So that let's call it settled. This could happen, right? So what is this called? I didn't say that. So basically my question here is B is transferring its inventory to D. Is this recorded as revenue? B is doing its ordinary activities and selling its inventory to D. Is it recorded as revenue? Revenue for B, yes. Is it recorded as revenue? Hmm? Why yes, why no? There's no relation between B and D. Exactly. D is not the customer of B. It's the customer of A. Where is my contract? Right? My arrangement is with A. But can I make this revenue in the name of A? No. Right? See, likewise, can A's transfer to C can be recorded as revenue for A? Absolutely not. Right? So these things does not come under the scope of IFRS 15. We have to record it in another way. It is not revenue. So that is what is meant by non-monetary exchanges between entities in the same line of business. One example it could happen is, you know, so just keep it in the back of your mind whenever a question comes like, what is non-monetary exchanges? Okay, whenever non-monetary exchanges like this comes, you understood the example? But in this case, if there is a verbal agreement, will it be satisfied? No, verbal agreement is between whom? No, if ABD comes into picture. Okay. Okay, and A B agrees with B that on behalf of A, I will transfer your goods. Right. So you have to go by the 5 conditions. First thing is identify the contract. Yeah, whether there is clear payment terms. Who will give the payment terms? What are the rights and responsibilities of each party? So what they are saying is don't break your head. If that is non-monetary exchanges, it will not come under the scope of IFRS 15. Okay. It applies to all other contracts except, right? Okay. All right. Now let's go into some definitions. So income. I think we discussed this definition before. Income is increase in economic benefits during the accounting period. Obviously, what is an economic benefit? Anything which is money or money receivable. Correct. So income is increase in economic benefits. Right. Whenever you earn an income, what is the entry? Accounts receivable or bank to income. Correct. So there is increase in economic benefits during the accounting period in the form of inflows or enhancement of assets or decrease of liabilities. It could be decrease of liabilities also. Sometimes, like, I have to pay him, but he say like, I go contract with him so that there is an income, so I adjust with the payable to him. So it could lead to increase of assets, increase in receivable, or decrease of payables. That results in an increase in equity. How does it result in an increase in equity? Exactly, because income will increase the profit and it will increase the retained earnings, which is a part of equity, other than those relating to contributions from equity participants. You understand the definition: increase in economic benefits during an accounting period in the form of inflows or enhancement of assets and or decrease of liabilities that result in increase in equity other than those relating to contributions from. It should be very clear now. Revenue, we know what revenue is. It is income arising in the course of an entity's ordinary activities. What is a contract? It is an agreement between two or more parties that creates enforceable rights and obligations. Pretty clear. What is a contract assets? We will come to contract asset later. But let's say that if you have a building, okay, you are a developer, you're constructing a building. The performance obligation, that means the customer can pay you back, can you can record it as a revenue only after you complete the building. What about the partly completed building? You have an enforceable right to get money back, right? So you account it as a contract asset. So we will be learning about contracts cost later, like all the cost incurred in a contract, whether you have to classify it as an asset or as an expense. We will just be going there. Same with contract liability also. You entered into a contract. Okay. Let's say that you received an advance. Okay. So let's read contract as an entity's right to consideration in exchange of goods or services that the entity has transferred to a customer when the right is conditioned on something other than passage of time. You will get to know, don't worry about contract asset. Receivable is entity's right to consideration, that is unconditional. Okay. Unconditionally, I'm going to get some money. And finally, contract liability, and the contract liability is an entity's obligation to transfer goods for which the customer. So let's say that I received an advance. Performance obligation is not satisfied. I will record it as a liability. Correct? It's a liability, current or non-current, based on the tenure of which I would be satisfying that obligation. So entity's obligation to transfer goods for which to a customer for which the entity has received consideration, or the amount is due from the customer. Okay. Now, who's a customer is the other party. Okay, who's contracted with the entity to obtain goods and services that are an output of entity's ordinary activities in exchange for consideration. And what is a performance obligation? What is a performance obligation? That's it. A promise in a contract to transfer either a goods or service, or a series of goods and service, series of distinct goods or service that are substantially the same and have the same pattern of transfer to the customer. Now, the point word here is distinct. Okay. A promise in a contract with a customer to transfer to the customer either a good or service that is distinct. What is meant by distinct? Hmm? Yeah, we will learn about what makes a contract distinct in a later section. But just understand that what is a performance obligation is a promise to deliver something which is distinct. Okay. Which could be one good or service or a series of goods or services. Right? What is standalone price? What is standalone price? So let's say that I am getting a phone plus a warranty for 1,000 dirhams. Okay. It's kind of an offer. Okay. If he's just selling me the phone, he would take 1,000 dirhams. Okay. Warranty I'm getting for free. Now, but this warranty, if I have to purchase, it is another 200 dirhams. So 200 is the standalone price of the warranty, even if it is not included in the transaction price. Okay. So the price at which an entity would sell a promised good or service separately to a customer. And what is transaction price? This is the amount. I am selling this mobile to you at 1,000 dirhams. Okay. So these are words which would be used interchangeably. Other than it's pretty clear. There is no word which should come back and be very difficult to understand. Okay, now they will not say entity obligation to transfer goods or an advance received. They will not use such language. They will use the language as contract liability. So you have to understand what it means. Okay, going forward. Getting it? Any doubts? Okay. Obviously, revenue does not include sales taxes, value added taxes, or goods and service taxes, which are only collected for third parties because these do not represent economic benefit flowing to the entity. Very clear. It's pretty obvious. Sales tax and other taxes If it is not an economic benefit flowing to the entity, there sometimes be other kind of taxes. Sales taxes, value added taxes, goods and service taxes. There could also be withholding taxes, right? So these are not included. Tell me about withholding taxes. How would that work? Withholding tax is a revenue or not? Why not? Right. But who's collecting? The customer is collecting, not the seller. There is a difference. Here, this sales tax, value added tax, and service taxes are collected by the seller, but there it is collected by the customer. So withholding tax could be part of revenue because it is value of transaction price all year only. Okay, you understood the difference between both, no? Hmm? Right. Now let's look at what we understood what is revenue and what are the main definitions. But let's look at revenue, recognition, and measurement. Now, what is meant by recognition and what is meant by measurement? Recognition is what they loosely call for entry. The entry that we put. How do you recognize in the financial statement? Oh man. Okay. So we were looking at recognition and measurement. So what is recognition? How do you recognize in the financial statements? Correct. And what is measurement? Measurement means what is the value to be measured, like included at the time of recognizing. So let's say that I sold this to you 4,000 dirhams, right? What is the recognition? I'm selling this mobile to you for 1,000 dirhams. What is the recognition? So cash or bank or AR slash bank to sales. That is recognition. Measurement is absolutely. Okay. So revenue recognition, IFRS 15 requires that revenue is recognized and measured according to a number of key criteria which follow a logical process. These criteria can be summarized in 5 steps, which we will consider. Okay, you know this way better than me. Identify the contract, identify the performance obligations. Once you identify the contract and the performance obligation, identify the transaction price, allocate the transaction price to the performance obligations, and recognize the revenue when the performance obligations are satisfied. Right? No need of any point of now I know that these 5 conditions are something that we always kind of show, but just see this exam focus point. This is what I like about this paper. Unless a question specifically asks you to list the steps required for revenue recognition, which will be rare, you will not be awarded marks in the exam for simply listing out these 5 steps. Therefore, do not waste time in the exam listing out these 5 steps if they have not been asked. This was raised again as an issue in examiner's report on June 24. Just don't write these 5 every time because you know this well. Don't. Okay, there are no extra brownie points for this. You will just end up wasting time. This what they are testing is not if you know the 5 conditions. They are testing if you really understand the recognition and measurement that is provided in the 5 conditions. Okay, just knowing this 5 would not help you. So let's go one by one. Hmm? So the first one is identify the contract with the customer. Okay. Now, what does it mean? Identify the contract. You tell me. Terms and conditions. Okay. What should you identify in a contract? Seller name, buyer name. Okay, fantastic. Rights and responsibilities of each party, yes. So that it helps us in understanding what performance obligations, right? What are the payment terms so that we know what is the transaction price. Then, is the contract commercially viable? So, let's say that you are buying this mobile to me for 4 million dirhams. Does it have some economic relevance at all? Or is the transaction or this contract masquerading as something else, right? So, we will see these things in the contract. Parties have approved and are committed to fulfilling the terms of the contract. That is number one. You should be approving this. Okay, you should be fulfilling, you should be having a commitment to fulfill, like, both buyer and seller. The seller should sell the product on time and buyer should pay the money on time. So that commitment should be there. Each party's rights regarding goods and services to be transferred can be identified. Payment terms for the goods can be clearly identified. The contract has commercial substance. It is probable that the entity will collect the consideration which it would be entitled, and also the contract can be written, verbal, or implied. So, what I mean to say is, you have to see if all these things are there in the contract. You have to identify these things in the contract, and then only you can pass the first thing. There should be a contract. Okay, the contract should have commercial reasonableness. Contract should be clear, and both parties should be committed to fulfill the contract, right? Payment terms are clearly identified, and it is probable that the entity will collect the consideration. So all these are very important. Okay, see, we use the contract with the customer is in the scope of IFRS 15 only when all of the following criteria have been met. It should meet all of these criteria, not just one. Okay, so what are the criteria you will take in hand? They are approved, they have a commitment to fulfill, then it should be mentioned. Then only we will know the performance obligations, right? The payment terms should be mentioned. The agreement should have a commercial substance. It should not be like, loose contract. And five, it is probable that the entity will collect the money. The seller will collect the money, and also the contract should be written, verbal, or implied. Okay, then only you can go ahead and record the revenue. Clear? You should look at all these things, right? Not just, we have seen live instances where revenue is recorded without even a contract. That will not suffice here. Then we have to identify separate performance obligation. So what is performance obligation? A promise. Yes, a promise by the seller to the buyer to, and vice versa. But here we look at the seller's obligations to the buyer because we are recording revenue for the seller, right? So the key point is, I told you, like, a promise to do two things. One, a distinct good or service, or a series of goods and services. Okay, a promise to deliver it on time. Now the question here I told you was distinct. How do you know it is distinct? What is meant by distinct goods and services? Any guesses? It can be sold separately. Okay. Okay. Let's see. Key point is distinct. A contract includes promises to provide goods or services to a customer. That is performance obligation. These promises are called performance obligation. A company would account for a performance obligation separately only if the promise to goods or services is distinct. Right? I will give you a simple example also so that we come into perspective instead of talking about. Now, I'm sending a contract to the customer. Okay. So I am going to give them company incorporation. Okay. Then rend finalization or finding commercial space, right? Then I will help them in renewals. Then I will help them in accounting, auditing, we corporate tax, transfer pricing, and VAT. I'm giving a combined bundle of this for an year, and I am charging him $50,000 for 1 year. Hmm? Now the key question here is we have to find how many performance obligations are there in the contract. Correct? And they said that each performance obligation should be distinct. Then only it will be called one. Right? Okay. If it is not distinct, then entire thing would be considered as one performance obligation. So we need to see how many performance obligations are there. Correct? So in this example, how do we find which are distinct and which are not? Let's read. You get the example? Okay. So let's see. So goods or service is distinct only if it is sold separately, or if it could be sold separately because it has a distinct function and a distinct profit. Okay, it is capable of being sold separately. Hmm? So what does it mean? So let's say that company incorporation, if it happens, then only I would need to find a commercial space, right? Only if the company is incorporated, then only we should think about renewals. Only when the company is incorporated, we should be accounting, auditing, CT, TP, everything would come only when it is incorporated, right? So can we say that the other things are distinct, or it is derivative of the company incorporation? So it does it mean that it's only one performance obligation or different? How? Yes, even though it is derivative, if only if you build the base, then only you can construct the second floor or the fourth floor. But it has a capability to be sold separately, right? So in that situation, it could be called as a distinct service. Okay. So when you say it is distinct, when the customer can benefit from the good or service in their own or together with other resources that are readily available to the customer. So customer can benefit from the goods and service either on its own or together with other resources. So let's say that customer wants accounting, okay, but he doesn't need auditing. So the customer can benefit from the good or services on its own, okay, and or together with other resources. Now auditing, even if he doesn't want to take some management, he can go outside and get it audited. So just because he's only taking accounting is not hampering his distinctiveness. Getting it? So we can say that even if he is only taking accounting and not auditing, or he's only taking auditing and not accounting, he can do the other thing from another person. So a customer can benefit from the good or service either in its own or together with resources that are readily available. Where is it readily available? It is readily available in the market, right? Then it is capable of being distinct. And the entity's promise to transfer the good or service to the customer is separately identifiable from other promises in the contract. Absolutely, because we are in the contract listing all these things, like there should be company incorporation, finding commercial space, renewal. We are not just giving a contract saying all compliance without separately identifying. Then also it is not distinct. Okay, so for having for how many performance obligations are there here then? 8. Why? Because if the customer didn't want this, he can enjoy this and get this readily available in the market, right? It's not that he should only consume it from some management. It's still available. I can take this from you and this I can take from outside. So that means these two are distinct, not one. Okay. So let's take another example where, like, you purchase this phone from me and you have to put Apple software. Then it is not distinct. You need me for both. You can't just buy Apple software from outside and just buy phone from me. Correct? Then it is combined one transaction, one performance obligation. Okay. So you have to see that there are two conditions, and if it is distinct, if both of the conditions are met, the customer is the entity's promises to transfer the goods and services is separately available. It is separately there in the contract that we will be taking care of all these, and it is not same as this. It is distinct from this, because if he only wants this and not this, he can find this from the market. So it is not combined. It is distinct. Okay. Getting it? So we'll read one more time. IFRS 15 states goods or service that is promised to a customer is distinct if both of the following criteria are met. A customer can benefit from the good or service either on its own. Okay, I can only do company incorporation, or together with other resources that are readily available to the customer. There are plenty of service providers readily available, which the customer can use. The entity's promise to transfer the good or service to the customer is separately identifiable from other promises in the contract. Okay, the contract does not say that it's a compliance package. It says what all the things that comes under the compliance package. Okay. All right. Can you do this question? Office Solutions, a limited company, has developed a communication software package called ComSoft. Okay. Office Solutions has entered into a contract with Logisticity to supply the following. So, Office Solutions is whom? The seller. A limited company has developed a communication software package called ComSoft. This is a product, right? They are selling it to Logisticity. Okay. What are the terms of the contract? What are they selling? License to use ComSoft. Installation service. They will also install ComSoft. This may require an upgrade to the computer operating system, but the software package does not need to be customized. Technical support for 3 years and 3 years of updates for ComSoft. Now, Office Solutions is not the only company able to install ComSoft, and the technical support can also be provided by other companies. The software can function without the updates and technical support. Explain whether the goods or services provided to Logisticity are distinct in accordance with IFRS 15 revenue from contract. Tell me how many performance obligations are there? Hmm? Why three? Why not four? Updates can't be so simple. Hmm? So as they're not the only company that's able to. Yeah, so how many performance obligations? How many distinct performance obligations are there? And to identify performance obligations for the purpose of according revenue, right? How many performance obligations are there in this? They are supplying four things: license, installation service, technical support, and 3 years of updates. Are these distinct? Hmm? Can you tell me some? Yeah, why? Why is license and installation distinct? Exactly. So they can consume the license on its own and avail, readily available, like, the definition here. You getting the definition now? So customer can benefit from license either in its own or together with other resources. That is installation, which is readily available to the customer. Okay. So yes, there are four. One, license is by itself, right? Without the license, we cannot run. But we don't need the installation service because I can get it done from another person. So license and installation is not one performance obligation, but two distinct performance obligations. Technical support for 3 years can also be provided by other companies, right? So I have an other accessible option available, and software can function without the updates and technical support. So how do you write the answer? See, comes off are delivered before the other goods. Comes off mean the license was delivered before the other goods or services remains functional without the updates and the technical support. It may be concluded logisticity can benefit from each of the goods and services either on their own or together with other goods or services that are readily available. This should come. Okay. The promise to transfer each goods and service to the customer are separately identified. In particular, the installation service does not significantly modify the software itself, such as the software and the installation services separate outputs promised by Office solutions rather than inputs required to produce a combined output. In conclusion, the goods and services are distinct and amount to four performance obligations in the contract under IFRS. Your conclusion is right, but you have to write like them as well. Okay. Now, should we go to determination of transfer transaction price today or we will do it tomorrow? We'll do it today. The guy looks very sick. So today or tomorrow? We'll continue or we'll. Hmm? No problem. Well, I can do that. I can do that. So basically, like we completed what? Identifying the contract. Correct? What are the things you should do when you identify the contract? Hmm? Yeah. Okay. You need to learn that because it says all the conditions should be satisfied. Second thing is identify the performance obligation. Performance obligation is a promise to deliver goods or services that are distinct or a series of goods or services which are distinct over a period of time. Now, the key question here is how do you understand if it is distinct? To understand if these performance obligations are distinct, we have to see two things: whether the goods or services can be consumed as it is by the customer or combined with other resources which are readily available. Okay. And two, these are mentioned separately in the face of the contract. You should identify that these things are there. Then these are distinct. Okay, both these conditions should be satisfied. All about performance obligation is identifying distinction. Okay, and if you can understand the number of performance obligation, then that is it. Now, what is transaction price? How do you identify transaction price? It is there in the contract, right? But things get a little skewed when there are few things. So, what kind of transaction price? What kind of prices would be there? Yes. Exactly. There would be a fixed compensation, okay, or fixed price. There would be variable compensation, and of course, there would be a factor of time value of money which would be placed. Okay, what is fixed contribution? There is no question at all. Like I am selling this to you for $1,000. Very clear. So what is variable consideration? When does variable consideration come into play? So here I will tell that say A is selling to B. Okay. Now the compensation is conditional upon something happening. So what will A sell is, see, if you buy during the year for 1 year, if you buy more than 500 units from me, then I will price it at $80 per unit. Otherwise, I will price it at $100 per unit. Right? So these things could happen. So we don't know whether and we are in 1/1/2025. Do we know how much he will buy for the whole year? Huh? So if he buys, let's say that he buys like 2 units from me today, at what price would I account it? In 100 or 80? These are the confusions it could come. We will discuss tomorrow because people are not well. And but this is variable compensation. TVM, I think you understand. If it is pay receivable after more than 1 year, then we should not we should include the time value of money, and the revenue should only be the principal portion. The remaining should be accounted as financing income. Let's come to that tomorrow. But moral of the story is variable compensation that is there. Then we will identify. We will resume tomorrow from here. Okay. Any doubts still what we saw? We only saw two things. Okay, how to find performance obligations, how to find how many number of performance obligations is linked to how distinct these performance obligations are. Okay, they will test you well on these things unless you understand the logic. Okay, so we'll resume tomorrow and we will get the rest of the things.